right. Can you guys hear me? How's everyone doing? Welcome back to the Wake of Analytics live stream. We're doing this to promote Wake of Trading course part one that I'm going to start teaching on August 25th. There is going to be an open door session, so please sign up for that. Want to talk a little bit about WTC1. There is always like some developments each week in preparation for the class. Obviously, I have mentioned the curriculum change. I would call WTC1 course now the chart reading and Wyckoff method course. So I'm going to be combining both of the ideas of chart reading and Wyckoff methodology. Those are two different things to me, even though conceptually, they are based on the same principles of the supply and demand, identification of that, identification of the change of behavior, and so on and so forth. Another change for WTC1 is that I've got a teaching assistant for this semester from one of our trainees. So he'll be responsible for having an additional optional for students, 1 hour per week sessions where he's going to explain the same concepts that I've explained during the class to the students. Sometimes I see how students might be like not inclined to ask a question. Maybe it's easier, to be in a less formal environment and so on and so forth. Some of you cannot make the class, live class, that is. So that new addition, the new teaching assistant, who is obviously very well versed both in chart reading and in Wyckoff methodology, is going to be of great help. So I'm looking forward to that. Okay, let's go to questions. I am not going to stay for a long today. I just have some domestic things that I need to attend to. So let's just go. Okay, Adrian is asking if I'm new to Wyckoff course and signed up for the classes, what are the three most important things for learning how to visualize Wyckoff trading course, I guess, or Wyckoff method? What are your go-to mini strategies to differentiate distribution over an accumulation? Okay, kind of like a general broad question. First of all, Adrian, looking forward to working with you. Um, like if we're just talking about uh, the differences between distribution and accumulation, then you're gonna look into the differences of the forces, number one, between supply and demand. There are ways of identifying that. And you're going to do this with the help of the volume and price action. You're also going to look at the structure, how the swings are moving within the structure, how are they interacting with the levels, and what's the character of the price and volume action as the price goes through specific characters. So we've developed what we call a sequential bias analysis. We've developed a lot of chart reading skills, for reading the trading ranges, and that's the main differentiation that we do as a piece of analysis. In terms of the mini strategies, I'm going to give you quite a few. Like the method itself is not a system. The method itself is a conceptual representation of why the market does what it does. And then you on your own could build your strategy around the things that you want. Some intraday trader might take a couple of concepts, like here and there, and insert it into his or her playbook. Other people might take a long campaign approach, and that's going to be completely different. That's going to be, like it's just a different mentality in terms of how to construct the system in a different time frame with the different asset on the different concept and so on and so forth. But yes, I will be giving you quite a few those quote unquote mini strategies. From Victor, how do you avoid missing trades in an uptrend because you think a change of behavior is developing and you're suspicious of the way the uptrend is resuming? How do you adapt quickly? For example, Palantir, end of June. Okay, I think this is going to be fair. If I'm gonna pull up the chart here of Palantir, yeah, look at this trend. Oh boy, it's so strong. Well, what do you think about a stock like this? I mean, when you go into the history, let's say like of the 1990s, when there were a lot of internet stocks, the internet just pop out as a new innovation. There was like this initial adaptation of that internet. AI is kind of the same this way right now. And when you are in that cycle of the new cycle of the diffusion of the meaningful innovation that is systematic, that's changing our society. That type of trend is going to last for a while. So it's not going to be your technical 1 to 3 to 6 months type of trend. No, the stock is going to go up, then it's going to consolidate, then it's going to go up again. Why? Because there is so much of revenue add-on from quarter to quarter, from year to year, based on this new innovation. So you should just keep that macro perspective when you think about the technicals. When you're trying to trade the stock, that you want to hold on to for a long time. And my suggestion was the stock like this to hold on to it until a meaningful change of behavior that is of cyclical nature or even of secular nature, not just like some small little reaction like we had back in, let's say, like March, April, or in 24 or in 23. And I've seen people who actually got in really nicely into this position and they couldn't hold on to it. So I personally don't have a position here. So maybe it's easier for me to say it this way, but we've been studying long-term campaigns for a while. I think that Wyckoff method works really well for long-term campaigns, and I don't see anything that is of a change of behavior that is so meaningful that the cycle is done. I mean, I see some deterioration of the demand right here as it goes up, but still it's pretty strong. Look at the deviation from the moving average, look at the gaps. The spread is diminishing a little bit. The velocity momentum is diminishing, so that is notable. And all of the strategies here are pretty simplistic. I mean, just any touch of the moving average, whether on the relative or the price, that's your point of entry. Okay, let's go somewhere else. Okay, Danny is asking, what are you looking for when you're looking for a Wyckoff? Is it at the, what is that, the point of interest or entry, or point of reversal, or the swing higher highs and lower lows, lower highs, and which time frame? Okay, I think I understand the question. So I think the question is at which point do you use Wyckoff methodology? Again, Wyckoff method, if you compare it to chart reading, right? So let me just write this down. I mean, are this the same things? Is Wyckoff method using chart reading or chart reading using Wyckoff method? It's probably both. I mean, there is mm, in chart reading so many concepts from Wyckoff methodology that's been described by R.D. Wyckoff himself that we use. And then in Wyckoff method, it teaches us how to read the chart. So they are very close things to each other, but at the same time, Wyckoff method has the layer of Wyckoff events, Wyckoff phases that chart reading does not. And chart reading is a very, very deep dive into how do you actually read the chart, bar by bar, swing by swing, structure by structure, volume by volume, and so on and so forth. So there is some distinction to me about that. So when would we use the Wyckoff method, or rather the concepts from the Wyckoff methods? Well, it's probably, you know, We always use it. I mean, Wyckoff method's three laws. First one, supply and demand. If supply is bigger, then the price is going to go down. If demand is bigger, then the price is going to go up. The law of effort versus result. If there is a harmony between the effort and the price, then everything is synchronized. If there is a divergent disharmony between the price and volume, then you're expecting some kind of attempt to react or reversal. And then cause and effect as law number three. So all of those are being used in chart reading. And with that, you can't really say that there is a separation. Now, when I look at the chart, how do I usually look at the chart? I look from left to right. It's very important for all of us, chart readers, to understand the background. What's the background? Distribution here that leads into a downtrend. Then you start reading the downtrend through the swing structure and through the volume signature. So here you start seeing, okay, there is quite a lot of climactic action associated with the weak hands capitulating and the strong hands are buying on the way down, as we see from the volume signature, and also on the way up, as we see from the up spread and the volume signature as well. Now, I could add some Wyckofian definitions here, and I could say that this looks climactic because of the way how the price moves, how the volume spikes up, how we're breaking the level, and then we're stopping the momentum, the velocity, the way how locally supply is being exhausted, and how the change of behavior occurs. Uh, um, as the price goes up. Also, the test. So I might say, okay, I'm seeing a selling climax. I'm seeing local test. I'm seeing change of behavior. I'm seeing the test of the change of behavior, and then I'm seeing the breakout of that, smaller structure somewhere here. Is that Wyckoff? Is that chart reading? That's both. So it all kind of comes handy. Okay, I hope that was it, Danny. Maybe not. Maybe I'm mistaken here. Big fan of you from India, from Sana. Sana, yeah, welcome. Uh, Good to hear. From Alim, hi Raymond. I'm planning to sign up for WTC1 course, but completely new to trading. Is there any prerequisite knowledge or skill I should have before starting? Yeah, just go to our website and we've got you know a lot of products that we've developed over the years. So if you go to the on-demand courses or product catalog, these are the main three courses that we have, and then just scroll down. Quite a few. Yeah, we've done a lot over the years. So this is the one that I would say, if you're a complete beginner, start here, basic charting course. That will cover very kind of like basic concepts that I believe Bruce Frazier and I were discussing in this course. This is going to be a technical analysis plus Wyckoff, so I would suggest that for sure. Also, even before that, you could start with charting essentials, which I would suggest just because it's completely free on our website. We've been advertising this on Twitter as well. So this is just, 1 hour of like the intro into the trend lines channels and, all of this technical analysis stuff. So those two things, charting essentials and basic charting course um, before the Wyckoff trading course. Okay, good question. Okay, from Oscar, how much weight has the seasonality patterns versus the price action? Um, I definitely use seasonality a lot, and with the help of Bruce, who brings the seasonality charts to our WMD sessions pretty often. And I must say that it depends on the year. how seasonally the year develops, but usually there is, somewhat of a high correlation that we find throughout our like weekly studies that we do in WMD class, because we look at seasonality, yearly seasonality, decennial seasonality, or any other analogs, and I'll talk about this in a second. I would definitely rely on the yearly seasonality, how that develops. Most definitely, there are huge exceptions, and you just need to understand that seasonality will work until it doesn't, and until it forms something different. So it's always based on probabilities, right, and how the economy is behaving in that particular year or that particular moment. So with that, rely on that, but at the same time, understand when that seasonal pattern breaks. And that's the key with the analogs. One of my all-time colleagues, as I was working with him on the analogs, and he's just brilliant with analogs. He was telling me like years and years ago, use the analog until it works, and then when it doesn't, use it as an opposing signal to whatever the analog was saying. And I think this is so true. So that has been my motto as I work with the analogs for decades. All right, interesting question. Was not expecting that. Okay, next one. Hishak. Okay, I am completely mispronouncing your name, so apologies. How to read gaps in the range-bound market. Okay, well, gaps are still gonna be the function of, let's say, strength or weakness of the current dominant force or the opposing force. So let's say like in this area right here, right? And obviously, you're going to interpret your gap or gaps that are going to be somewhat similar through the context of where they are, right? So here we're seeing a big change of behavior bar back in December of 24 that produces the range bound environment. It's being stopped right away. So here we might be thinking, is this an element of strength? Is this demand coming in? And most definitely demand is coming in as we look at this volume signature back in December of 24. So what does it mean? It means that with this selling, demand is coming in, and now the forces are balanced, and we're going to be in the trading range. So that change of behavior initial on this bar defines the next environment. So with that, what happens next? Demand is coming in, absorbs the supply, and both forces are going into testing, testing, testing. Supply locally is being diminished enough to produce the rally. This is the best rally out of the rallies that we've seen here, but it cannot overcome the all-time high, which is a negative, and then right away a gap occurs. So this gap is in kind of like off the top of the structure into the middle of the structure into the mean. So how do we interpret this? Based on the background of the change of behavior, based on the local exhaustion and an attempt to rally that fails, you look at the gap as an aggression here. And then after the gap, it seems like we have a volume spike here. So what is it? Is it supply or is it demand? Well, obviously it's both. But because of the tail, we know that demand is coming in. The next bar is the follow through bar to the upside. So this looks to be okay. So then what does the price need to do now after the gap? The intention is to overcome the resistance, to overcome the all-time high. Do we do that? No. Not only that, demand is diminishing and then we're producing another gap. So what does that mean? Well, that means that supply is still aggressive. It actually improved as the close is lower than on the previous gap day, and the gap itself increases, and the close is into the tail here and below the mean. So that's how you kind of like gauge all of the gap action. And you could also compare, let's say, like a down gap to the up gap. So I already see like a down gap here was larger than the up gap right here. And all of that aggression of gaps to the downside in the middle of the structure is being followed by the rally that is deteriorating relative to the rally that we had in January of 25. So when you put this whole picture together, the context, the result, the gaps, and the way of how demand and supply change its strength into weakness, you can use gaps and gauge to what kind of bias of the trading structure we have. Okay, yeah, interesting questions today. Very, very specific. Okay. Okay, I see more of the comments. Let's see if we have any other questions. At the turn of July and August from Morrow, don't we see a change in nature of the market? July and August, right here, right? This year, 25. An increase in volume on a decrease, and now with higher prices, we have an increase on a decrease in volume. Okay. Yeah, we've talked about this in the previous sessions, right? So looking at the swings, what happens here? These are the swings. Let me just take another color. This is a structure. So, oof. Okay, like this. Okay, so I'm not looking at this rally in between. So let's just go through this. I mean, obviously, off the bottom, lots of buying, very aggressive. That was such a beautiful day to trade. So much money been made on that particular day with the announcement from the administration. Just was crazy, crazy day, and so strong, right? So was what the third strongest day that we've had in the history of the market, something like that. So what's going to happen with the price movement after the test? Is it going to go the same way? Probably not. I mean, this type of the events, they're quite rare when we look at the history of the market. So that in one day we have that type of move in the broad market, not in the specific stock or specific asset, but in the broad market. So then, as we go into the next swing, what do we see? All right, well, are we seeing some improvement? We're definitely seeing some improvement in the distance of the swing. We are definitely overcoming the resistance that we stumbled into with this big up bar at the beginning. We are definitely seeing those gaps that we've just talked about, element of strength. Whatever you know tests we have along the way of the swing, looking at them, those are just so mediocre. Here's the test, here is a test, here is a test, here is a test. It's all kind of like price, resting on the top of this structure right here. Attempt to go down as a test and then the recovery. So this means we're still going up. Gap, continuation on the exhaustion bar into this breakdown. Supply comes in, but there is nothing on the supply side. These are two lowest supply volume signatures that we're seeing, and then gap again, and then attempt to break out again, and exhaustion of that breakout. It all looks very positive, right? So then when we go to the next swing, let's say from June of 25th to about end of July, what do we see? The distance has diminished, the spread has diminished. Um, but at the same time, even though we see the deterioration by the demand or of the demand, we also see this in the volume signature, the way of how it's just lower than the one for the rally in May. But at the same time, what do you see for the supply? A lower level, supply is diminishing, nothing is going on. Okay, well, maybe sometimes supply might develop some ease of movement behind the deterioration of the demand. Could we catch that? Well, the price needs to break something, and instead the price is breaking only to the upside. Extension above the all-time high, the horizontal test, which is much stronger, not even touching that previous all-time high, and then continuation up. As we come in finally with some profit taking, with some selling, this selling is, if we were to compare this selling right here, the most recent one, is on par in terms of the reaction to this reaction right here, in terms of the price movement. It's of the same magnitude, and it's not the same magnitude as the secondary test. I was expecting a more meaningful reaction like we had on the secondary test, so that we would, start showing some kind of, proportionality of the reactions. But here we just clearly in this right here. Okay, let me just put some lines. Yeah, we're in this stride. So we just changed the stride of the move. The first momentum kickoff stride that we have here, and now we're in a completely different stride right here. Is momentum decreasing? Yes. Is demand decreasing? Yes. Is supply decreasing when we're rallying right here in this area? Supply is decreasing. Well, then is supply coming in? Yes, here and here. And what is the result of that supply coming in? Steel absorption, steel absorption. It's their ability to understand that the trend lasts for a while. And you have to be able to stick to a trend. That's one of the hardest skills to develop as a trader. It doesn't really matter whether you're a Kaffian or you're a Letition or maybe you use cycles, GAN, whatever. It doesn't matter. A good profitable trader will have in his or her repertoire, some kind of trending setups and trending techniques, and develop the ability to stay within the trend for a long time until not just deterioration of the dominant force, which in this case is demand, happens, but until actually, some change or preconditions to change is going to occur. And that's what we're looking for. Okay. Mhm. Okay. All right. Good question. Yeah. So more hopefully just all explained in terms of why there is no demand, right? So demand also just gets exhausted in these areas, right? Supply is coming in, absorption happens. What do you think happens with the demand? Obviously, it decreases. Why? Because think of like a limited demand that we have. Let's say out of 100% of the demand, and we used maybe 70% of it. Is demand going to be increasing? No, it's going to be decreasing. But because it absorbs supply, it's in control, so the price will go up. It's going up behind the idea that supply is just very much exhausted. Okay, guys, this is going to be a short session today. I'm going to stop here. I just have some things to attend. But I think that we have two more sessions like this. So get your questions ready next Wednesday at the same time, 7 a.m. Pacific. We're just going to go through whatever questions you have. Again, just want to page WTC one course. Just a lot of work lots of homeworks, lots of knowledge, skill building exercises, just a lot of stuff that I'm going to give you. And usually the feedback from students is phenomenal. So just after like a couple of months, people are saying like, I see market in a different way. I see structures, I see the forces, I see the change in the force and how that influences the structure. So for those of you who are interested in chart reading and Wyckoff method, yeah, absolutely. Come to our website, wyckoffanalytics.com, sign up. I will be happy to work with you live and on demand this semester. So with that, thank you so much for being here. And until next Wednesday, thank you. Bye-bye.